If you're over 50 and you still have a 30-year mortgage hanging over your head, this video is for you. I want you to picture something. That big, heavy house payment that shows up every month, gone in 5 to 7 years. I'm going to walk you through how many people have taken a 30-year mortgage and wiped it out in 5 to 7 years without winning the lottery and without living on beans and rice in the dark. Because the truth is, walking into your 60s and 70s with 20 plus years left on your mortgage can be one of the most dangerous financial decisions you make. It can steal your retirement freedom, limit your choices, and keep you working longer than you want. That monthly payment doesn't care if you're tired, if your back hurts, or if you'd rather be on a beach with your grandkids. We're going to talk about how mortgage interest really works against you, a step-by-step plan to attack it, smart ways to find extra money for principal when you should not rush to pay off your home, and how to balance all of this with retirement investing so you don't end up house rich and cash poor. If your home could be completely paid off in the next 5-7 years, what would that change in your life? Would you keep working? Would you retire earlier, travel more, help your kids or grandkids, or just sleep better, knowing no bank can ever take your home? By the end of this video, you'll have a clear roadmap to either pay your home off early, or at least know if that's the right move for you. I'm George, reaching you through the platform, George Edward Explains. And before we go any further, let me say this clearly. This is education, not personalized financial advice. Before you make big decisions about your mortgage or your investments, talk to a qualified financial professional who understands your full situation. There's an old saying that goes, "The borrower is slave to the lender." My goal today is to help you break those chains sooner and to do it smart. Now, before we jump into the how, we need to talk about the should. Should you even pay your mortgage off early? This is not a one-size-fits-all answer, especially if you're in your 50s, 60s, or 70s. On paper, there's a classic argument. If your mortgage rate is low, say 3-5%, and you could possibly earn more than that by investing, why pay it off early? Keep the cheap debt, invest the extra, and you'll be better off. On a spreadsheet, that can look very clever, but life is not lived on a spreadsheet. There's another side to the story. Being completely debt-free, especially in your later years, has a value that doesn't always show up in a calculator. The feeling of knowing the roof over your head is truly yours. That's powerful. If you're 55, 60, 65, you don't have 40 working years ahead to recover from big surprises. A paid-off home can be a huge emotional and financial safety net. On the other hand, if paying off your mortgage early means you have no emergency fund, no savings for repairs, and nothing going into retirement accounts, that's dangerous too. You don't want to be the person with a beautiful paid-off home and no money for medicine, food, or a new furnace when the old one dies. Let me give you 2 quick pictures. Years ago, I knew a couple who became obsessed with paying off their mortgage. They threw every extra dollar at it. Within about 8 years, they had it paid off, which sounds wonderful. The problem? In those 8 years, they barely saved anything else. No emergency fund, very little in retirement accounts. Then he got sick, had to stop working earlier than expected, and guess what? They had to borrow against that house just to live. They went right back into debt, this time with a more expensive loan. Then there was another couple I watched. They hated the debt too, but they took a balanced approach. They kept a solid emergency fund, put money into retirement accounts, and then still paid extra on the mortgage. They didn't pay it off quite as fast, but when it was gone, they also had investments in cash. They weren't just free from the bank. They were free to live. So ask yourself, which scares you more? Having a mortgage payment in your 70s or having no savings in your 70s? For you, it might be a bit of both. That's why we're not going to say everyone must pay off their mortgage in 5 years no matter what. We're going to say, here's how it can be done, and here's who should and should not push that hard. If you're thinking, George, I don't even know my own numbers, that's your first homework. Do you know your current mortgage interest rate? Do you know how many years are left? If you don't, make a note to look it up after this video. Those 2 numbers alone can change how you feel about this whole topic. There's a bit of wisdom I like. You don't have to swing at every pitch. You don't have to rush to pay off a mortgage if doing so would destroy other parts of your plan. You get to choose which pitch you swing at. But if being mortgage-free in 5-7 years is a pitch you want to swing at, let me show you how the numbers really work. Let's pull the curtain back on mortgage math, because once you see it, you'll never look at your payment the same way. A traditional fixed 30-year mortgage is simple on the surface. You borrow a big chunk, you pay a fixed amount every month for 30 years, and at the end it's gone. But inside that simple payment, something sneaky is going on. In the early years, most of your payment goes to interest, not to paying down the amount you owe, which we call principal. Only a small slice goes to actually reducing your debt. Over time, that slowly flips. More goes to principal, less to interest. But for many, many years, you're mostly feeding the bank. Let's use round numbers. Say you have a $300,000 mortgage at 5% interest for 30 years. Your monthly payment just for the loan, not counting taxes and insurance, is roughly around $1,610. Over 30 years, if you just make that minimum payment, you'll pay back about $579,000 in total. Out of that, about $300,000 is what you borrowed, your principal, and about $279,000 is interest. In other words, if you stretch it out for the full 30 years, you pay almost another house's worth of money in interest alone. Now, if you manage to pay that same loan off in, say, 7 or 10 years instead of 30, the total interest paid drops dramatically. You don't need the exact math to see the idea. The sooner you crush the balance, the less time the bank has to charge you interest on it. Here's where things get interesting. Every extra dollar you send to principal today is a dollar the bank doesn't get to charge interest on for the next 20 plus years. If you add an extra $200, $300, $500 a month, you are not just paying a little faster. You're cutting into the bank's schedule of earnings. Imagine two people, both 55, with the same $300,000 mortgage at 5% and the same $1,710 payment. Person A just pays the minimum and plans to ride it out for 30 years. Person B decides, I want this gone by the time I'm 65, and starts paying an extra $500 per month toward principal every month from age 55 to 65. Person B might knock 10, 12, maybe even 15 years off the mortgage, depending on when they started and their exact rate. They could save tens of thousands of dollars in interest and walk into 65 completely free of that payment. When I was younger, I remember looking at an amortization table, the schedule that shows how much of each payment is interest and how much is principal. I thought, surely most of my payment is going to the loan itself. Then I saw the first few years, hundreds and hundreds to interest, a little bit to principal. It hit me like a punch in the gut. I said out loud, I'm working for the bank. That day changed how I thought about debt. There's a sharp line I once heard about compounding. The first rule is never interrupt it unnecessarily. Right now, with your mortgage, the bank is the one enjoying compounding on your back. Every month you pay the minimum, you're helping their money compound. When you send extra principal, you are interrupting their compounding, not yours. You're cutting off future interest before they can earn it. Let me ask you, how much interest has the bank scheduled to earn from your mortgage over the next 20 plus years? If you've never checked, that's a number worth looking up. And how would it feel to take tens of thousands of those dollars that were on their side of the ledger and quietly move them over to your future, your retirement, your family? Now let's get practical. How do you actually crush a 30-year mortgage with a payment plan? Step one is to know your numbers. You need to know your exact remaining balance, your interest rate, how many years or months are left, and what your current monthly payment is, just the loan part, not taxes and insurance. If you don't have your latest statement handy, make a note to grab it. Step two is to choose a target. If you're 55 and want it gone by 60, that's a 5-year goal. If you're 60 and you'd love to have it gone by 67, that's a 7-year target. So ask yourself right now, what year do you want to be able to look at your spouse or call your kids and say, our home is paid off? Step three is to use an early payoff calculator. You don't have to be a math whiz. Just search online for Mortgage Payoff Calculator. You'll see tools where you plug in your balance, your rate, and either your desired extra payment or your desired payoff time. Conceptually, here's what happens. If you tell the calculator, I want this gone in 7 years, it will tell you, okay, instead of paying $1,610 a month, you need to pay around X per month to hit that goal. Maybe that number comes back as $2,500 per month. I'm making that up as an example, but that's how the tool works. Step four, decide your extra payment style. There are a few ways to do this. You can choose a fixed extra amount each month. For example, you decide, from now on, I will pay an extra $400 every month toward principal. That turns your $1,710 payment into $2,010. Over time, that can shave years off your loan. You can switch to biweekly payments. Instead of one full payment each month, you pay half the payment every 2 weeks. Because there are 52 weeks in a year, that means you make 26 half payments, which is the same as 13 full payments instead of 12. That extra payment each year goes straight to principal and can silently cut years off your mortgage. You can also use lump sums. Maybe you get a bonus, a tax refund, a small inheritance, or you sell something you don't need. Instead of letting that money just sit or drift into everyday spending, you decide in advance. Lump sums go to the mortgage. A $5,000 or $10,000 one-time hit to principal can knock off a surprising amount of future interest. However you choose to do it, step 5 is key. Automate it. Don't rely on willpower every month. Set your bank's bill pay to send the higher amount as your new normal payment, and make absolutely sure the extra is going to principal. Sometimes lenders will treat extra money as an early payment toward next month instead of as a principal reduction. You want it clearly applied to principal now. Call your lender and ask, how do I make sure anything above my regular payment goes directly to principal? In my own life, I remember the first time I nudged a payment up. It wasn't anything heroic, just an extra $100 at first. For the first 2 or 3 months I felt it, then it became normal. 6 months later I increased it again. The funny thing is, we adjust. What feels impossible now can feel routine once you build your life around it. One day I logged into the account and saw the balance had dropped faster than I expected. That was a good feeling. Ask yourself, what if you treated your mortgage not as a 30-year home loan, but as if it were a 7-year car loan? What would that payment look like? How much extra each month would you need to find to make that happen? There's a phrase I like: discipline is the bridge between goals and accomplishment. Your extra payment plan is that bridge. The question is, are you willing to cross it? Of course, having a plan is one thing, finding the money is another. Let's talk about where that extra principal can realistically come from if you're over 50. First, trimming the fat, expenses. I know nobody loves talking about cutting back, but a lot of people in their 50s and 60s have money leaking out of their life in ways they don't even notice. Old subscriptions you don't use, premium cable or streaming packages with channels you never watch, eating out more than you realize, always choosing brand name groceries when the store brand is nearly identical, memberships to gyms or clubs you rarely attend. Here's a challenge. Could you free up $200, $500 a month from your current lifestyle without feeling truly poor or deprived? Many people can once they sit down with a bank statement and a red pen. Go line by line for 1 or 2 months. Put a question mark next to every expense that doesn't clearly make your life better. Then ask, would I rather have this or shave years off my mortgage and my work life? Second, right-sizing your housing or lifestyle. For some folks, particularly empty nesters, the house itself is bigger than they need. Downsizing to a smaller home or moving to a slightly less expensive area can do 2 things: give you a smaller mortgage to crush, and sometimes free up cash from equity. I'm not telling you to sell your home and move to a shack, but I've seen people in their 60s holding on to a 4-bedroom 2-story they no longer enjoy walking up and down, when a smaller 1-story would not only be easier on the knees, but easier on the wallet. Another idea, not for everyone, is using your house to create income. Renting out a room to a student or a relative, or using part of the house as a short-term rental if your area and your comfort level allow it. Safety and privacy matter, of course, but I've seen folks create an extra $500 to $1,000 a month this way and send every dollar of it to principal. Third, boosting income. Yes, even after 50. Many people in their 50s, 60s, and even 70s underestimate what they can earn on the side. You have decades of skills. Maybe you can consult in your old field a few hours a week, tutor, drive part-time, do bookkeeping, handyman work, crafts, pet sitting, online freelancing. The key is not how impressive the work sounds to others. The key is that every extra dollar from that side income goes only one place: extra principal on the mortgage. I once knew a man in his late 50s who loved woodworking. He started making simple furniture pieces and selling them online and at local markets. He told me, "George, my goal is $500 a month. That's it." Every cent went straight to his mortgage. 3 years later, he had cut off almost 7 years from his loan schedule. It wasn't just the money. It was the focus. The work had a mission. So let me ask you, if I told you that an extra $400 a month could cut 8 to 10 years off your mortgage, would you at least look for it? Which is harder for you emotionally, cutting expenses or adding income? Be honest with yourself. You might not love either, but you may find one easier than the other. Use that. I once read a line that said, "Don't save what is left after spending. Instead, spend what is left after saving." In our case, think of it this way. Choose your extra mortgage payment first, then build the rest of your budget around what's left. Treat that extra principal like a bill you owe your future self. Now, before you go charging like a bull at your mortgage, we need to talk seriously about who should not rush to pay it off and about some common mistakes that can turn a good idea into a bad outcome. First, if you have very little emergency savings, less than 3 to 6 months of essential expenses in cash, pouring every extra dollar into your mortgage is dangerous. If you lose a job, or your spouse gets sick, or the car dies, you can't pull cash out of your walls to pay for it easily. You may end up putting those emergencies on high-interest credit cards, which is far worse than keeping a slightly larger mortgage balance for a bit longer. Second, if you are over 50 and have almost nothing in retirement accounts, you can't ignore that. A paid-off house with no retirement savings can still feel like poverty. You might not have a mortgage, but you also don't have income. In that case, you may need to split your extra money, some toward retirement investing, some toward faster mortgage payoff. It doesn't feel as satisfying as going all in on one thing, but it's safer. Third, if you have high-interest debt, credit cards at 18 to 25%, personal loans at double-digit rates, those usually must be tackled before you aggressively prepay a 4 to 6% mortgage. The interest dragging you down there is far heavier. Think of it this way. Every extra dollar you send to your mortgage saves you 4 and 6% interest. Every extra dollar you send to a 20% credit card saves you 20%. That's a slam dunk priority. Common mistake number 1, going completely house rich and cash poor. I've seen people who paid their house off in a blaze of glory, then had no savings at all. One medical bill, one major car repair, and they were borrowing again, this time through home equity lines or credit cards, often at worse terms. They had won the mortgage battle but lost the financial war. Common mistake number 2, raiding retirement accounts in a tax-heavy way to pay off the house. If you pull a big lump sum from a traditional IRA or 401k to kill your mortgage in one shot, you may push yourself into a much higher tax bracket for that year. You could hand the IRS tens of thousands of dollars you didn't have to. Sometimes it's smarter to take smaller bites over several years, staying in lower brackets. This is exactly the kind of move where you must talk to a tax-aware professional first. Common mistake number 3, taking on risky investments or weird loans hoping to get a lump sum payoff. I've seen folks chase some can't-miss investment because they dream of using the profit to pay off the house. Then the investment goes south and they're left with the mortgage and a hole in their savings. Slow and steady wins this race more often than swinging for a home run. Common mistake number 4, not checking if your mortgage has prepayment penalties. Most modern loans don't, but some do, especially if they're older or more unusual. You don't want to find out the hard way that your extra payments are triggering fees. Call your lender and ask directly, are there any penalties or restrictions on paying extra toward principal or paying off early? I think of a woman I knew in her early 60s. She got so focused on being debt-free that she used nearly all her savings to make a huge lump sum payment on her mortgage. A year later, her roof started leaking badly. She didn't have enough cash to fix it, and because she was on a fixed income, the bank wouldn't give her an easy loan. She had to put the repair on a high-interest credit card and then struggled with that payment for years. Contrast that with another family I know who kept a chunky emergency fund, continued to invest for retirement, and still paid extra on the mortgage. They took a bit longer, but when the house was paid off, they were not scraping by. They were free. There's a line of wisdom that says the essence of smart money management is managing your risks, not just chasing returns. Paying off your mortgage fast can be a powerful move, but only if it's done as part of a bigger risk plan. It should lower your risk, not create new ones by draining your safety net or blowing up your tax bill. And remember that earlier disclaimer. All of this is general education. Your situation is unique. Before you adopt an aggressive payoff plan, especially if it involves changing investments or pulling from retirement accounts, sit down with a qualified financial professional who can look at your whole picture. So let's turn all this talk into something you can act on this week. A simple 7-day action plan. Day 1 and 2, get clear. Pull out your mortgage statement or log into your account. Write down your remaining balance, your interest rate, how many years are left, and your current monthly payment for principal and interest. Then go online and search Mortgage Payoff Calculator. Plug in your balance and rate and play with it. Ask the calculator, what if I wanted this gone in 7 years? What if I wanted it gone in 5? Look at the payments it shows. You don't have to decide anything yet. Just see the range. Day 3 and 4, decide your goal and a starting extra payment. Based on what you saw, choose a realistic target. Maybe you say, my goal is to be mortgage-free in 7 years. Ask yourself, what extra amount each month would move me meaningfully in that direction without wiping out my emergency fund or stopping my retirement saving? You might land on a number like $200, $400, or $800 per month. Put that number in writing. Also write, I will still keep at least X months of expenses in savings, and I will still invest Y per month for retirement. Day 5 and 6. Find the money. Sit with your spouse or by yourself if you're single and go through your recent bank and card statements. Circle 3 categories where you can trim, maybe eating out, subscriptions, and miscellaneous. Then brainstorm one income idea you could try, maybe a small side project, a few extra shifts, or selling unused items around the house. The goal is to identify where your extra payment will come from. It doesn't have to be perfect. You just need a starting plan. Day 7. Automate and commit for at least 6 months. Call your lender or set up your bank's bill pay to send the new, higher amount as your regular monthly payment. Confirm on the phone or in writing that anything above your required payment will go straight to principal. Then make a personal promise. I will stick with this plan for at least 6 months before I reevaluate. 6 months from now, log in and look at your balance. I suspect you'll like what you see. Let me leave you with a couple of questions. What will your life look like 7 years from now if you actually follow through and your home is paid off? Picture yourself walking to the mailbox and not seeing that mortgage bill ever again. What would it feel like to enter your 60s or 70s with no mortgage at all, knowing that whatever else happens, you own the place you sleep? There's a line I've carried with me for years. Success is nothing more than a few simple disciplines, practiced every day. Let this be one of your simple disciplines. Decide your payoff plan, fund it every month, protect your safety net and your retirement, and give yourself the gift of a debt-free home on purpose. If this helped you, tap the like button so more people our age can find it. In the comments, tell me, how many years are left on your mortgage, and what year would you love to see it gone? And if you want more plain English guidance on money after 50, subscribe to George Edward Explains and hit the notification bell. I'm George. Thanks for spending this time with me. Now go grab that statement, know your numbers, and start building your plan. Your future self is waiting for you on the other side of that last payment.